Welcome back to John Smith 02, and if you have been watching the news this past week, you already know that things in the Middle East have gotten very complicated very fast. There is a lot happening right now with the United States and Iran that is directly moving gold and silver prices, and if you hold either of those metals, or if you are thinking about them, you need to understand what is going on. Today we are going to break this down step by step because there are really three separate stories happening at the same time, all pulling the precious metals market in different directions. There is the geopolitical story, Trump renegotiating the deal with Iran. There is the physical market story, something unusual and historically significant happening on the COMEX exchange floor with silver delivery demand. And then there is the central bank story, because the people managing the world's reserve currencies are quietly but aggressively buying gold. Those three stories are connected, and once you understand how, the price action you are seeing in gold and silver this week will start to make a lot more sense. Let's start with the Iran situation because that is the news everyone is talking about. For the past several months, the United States and Iran have been in a state of active military conflict. The Strait of Hormuz, that narrow waterway off the coast of Iran, through which roughly 20% of the world's daily oil supply passes, has been disrupted, contested, and partially blockaded. The United States military has been disabling commercial ships that violated a U.S.-imposed blockade on Iranian ports. By late May 2026, at least 5 commercial vessels had been disabled and more than 100 redirected. When a choke point controlling 20% of global oil moves from theoretical risk to actual disruption, that is not a background news story. That is a seismic economic event, and markets have been responding accordingly. Now here is where Trump enters the picture in a very specific way. By late May, U.S. and Iranian negotiators had gotten close to a tentative agreement. There was a memorandum that included a 60-day ceasefire, commitments around the Strait of Hormuz, and a framework for longer negotiations on Iran's nuclear program. Trump's own envoys had put the deal together, and for a brief moment, markets responded optimistically. Oil dropped sharply, equities moved higher, and gold pulled back as some of the safe haven fear came off the table. But then Trump asked his team to make changes to the draft. He wanted tougher language on nuclear commitments. He wanted specific concessions on enriched uranium. He wanted the highly enriched uranium stockpile addressed before anything else moved forward. Treasury Secretary Scott Bessent made clear that sanctions relief would move very slowly and that the Hormuz opening and Iran's agreement on enriched uranium were non-negotiable preconditions. Vice President Vance acknowledged the deal was not done and could not be guaranteed. Now think about what this looks like from the market's perspective. One day you have a deal that looks largely finalized. Oil drops, gold dips, equities surge. The next day you have U.S. strikes on Iranian targets in southern Iran, a reversal in oil back above $92 a barrel, and gold safe haven demand flaring back up. This is exactly the kind of back-and-forth, on-again, off-again diplomatic environment that creates whipsaw volatility in precious metals. And that is precisely what gold and silver investors have been living through. Let's break down what that volatility actually looks like in price terms. When the Iran conflict first escalated in early 2026 and the Strait of Hormuz came under threat, gold broke through the $5,000 per ounce level for the first time in history. That is not a small milestone. That is gold telling you something fundamental has changed in how the world perceives risk. But when ceasefire talks began to look credible, gold pulled back. By late May 2026, spot gold was trading near $4,500. As of early June, experts project gold in a range roughly between $4,400 and $4,800 for the month, with the $4,800 plus level in play if the Iran situation escalates or the dollar weakens. On the downside, a hawkish Federal Reserve response to oil-driven inflation could push gold back toward $4,400, though most analysts see that level as strong support. Here is what this means for you as someone trying to understand this market. Gold right now is being pulled in two opposite directions simultaneously. On one side, geopolitical fear, the Iran war, the Hormuz disruption, uncertainty about whether a deal gets done, pushes gold up. On the other side, the inflation feedback loop. High oil prices push inflation higher, which makes the Federal Reserve less likely to cut rates, which strengthens the dollar, which pressures gold. These two forces are arm wrestling in real time, which is why you are seeing such sharp, sudden moves in gold prices whenever a new headline lands out of Washington or Tehran. Silver is dealing with those same forces, but with an important added layer. Silver is not just a safe haven metal, it is also heavily industrial, and that dual nature means it responds differently than gold. When the Iran war began and oil surged and inflation expectations jumped, silver actually fell more than 20% from pre-war levels. Higher oil means higher inflation, which means the Fed holds rates higher for longer, which is bad for industrial metals because it signals slower economic growth. Silver dropped toward the $72 range at one point during the most intense period of the conflict. But as ceasefire talks advanced, silver recovered significantly, and by late May it was trading near $76 an ounce, though still showing volatility as negotiations continued to shift. And this is where the story gets genuinely fascinating, because underneath all of this geopolitical noise, there is a structural physical market story in silver that has been unfolding for months and is arguably more important than the day-to-day Iran headlines. Let me walk you through this carefully, because it is the kind of thing that most casual market watchers are not paying close enough attention to. The COMEX exchange is where silver futures are traded in the United States. It is essentially a marketplace where buyers and sellers agree on prices for silver to be delivered at a future date. Most participants never intend to take physical delivery of actual silver. They are trading paper contracts, speculating on prices, hedging risk. That is perfectly normal and how commodity futures markets have worked for decades. But something unusual has been happening at COMEX in 2026. The ratio of paper claims on silver to actual physical silver sitting in COMEX vaults has reached extraordinary levels. For every single ounce of registered deliverable silver in those vaults, there are roughly 6 to 7.5 paper claims stacked on top of it. The coverage ratio, the percentage of open interest that could actually be covered by physical delivery, has been sitting in the range of 13 to 17%. Think about that. The system is only physically backed to between 1/7 and 1/6 of its total paper obligations. Now here is what makes this cycle different from previous years. Institutional investors and industrial users have been demanding physical delivery at a rate that is historically unprecedented. In January 2026 alone, roughly 33 million ounces of silver were physically withdrawn from COMEX vaults in just 7 days. That represented approximately 26% of COMEX's registered inventory disappearing in a single week. March 2026 saw more than 46 million ounces demanded for delivery in a single month. COMEX vaults have been draining at a pace that has pushed registered inventory below the 100 million ounce threshold, a level that market analysts watch closely as a psychological, structural signal of tightening supply. On some days in April 2026, between 1.8 and 3.1 million ounces were pulled from eligible vaults in a single session, while fresh inflows were as low as 5,000 ounces. The math on that is stark. Why is this happening? Several reasons are working together. Industrial users, companies that need physical silver for solar panels, semiconductors, EV components, and AI infrastructure, have been securing supply directly rather than rolling futures contracts and trusting that the metal will be there later. They are looking at a global silver supply deficit, now in its 6th consecutive year, and deciding that holding a piece of paper that says you can get silver later is not the same as having silver in hand today. At the same time, institutional investors have recognized the disconnect between paper pricing and physical scarcity, and some are choosing to take delivery as a way of locking in real metal rather than staying exposed to a paper market where the coverage ratio is dangerously thin. There is also a geographic dimension to this. Shanghai silver prices have been trading at a significant premium over Western spot prices, at times as much as $10 above Western market levels. That tells you the Eastern physical market is pricing scarcity differently than the Western paper market. When Shanghai prices are that much higher, it signals that Asian buyers cannot or will not rely on Western exchange arbitrage to meet their physical needs. The global silver market has, in a meaningful sense, fragmented, and COMEX is bearing delivery pressure without the relief valve of Chinese arbitrage flows it previously relied on. This is worth pausing on because it is actually quite significant. If you have been wondering why silver has maintained relatively elevated prices even during a period when inflation fears should theoretically pressure industrial metal prices down, this is a big part of the answer. The structural physical demand is acting as a floor. Industrial users cannot simply stop needing silver because interest rates are high. A solar panel manufacturer still needs silver paste. A semiconductor factory still needs silver contacts. The inelastic nature of industrial silver demand means that even in a complicated macro environment, the physical market keeps pulling. If you are finding this useful and want to stay on top of market developments like this, hit the like button and subscribe to John Smith 02. We break down exactly these kinds of layered market situations every week. Honest, clear, and genuinely useful for everyday investors. No fluff, no agenda. Just the market, the data, and what it might mean for you. Now let's talk about the third piece of this puzzle, central bank gold buying, because this is the part of the story that tends to get underreported in mainstream financial media. Central banks around the world have been purchasing gold at a historically aggressive pace. China alone reportedly acquired 800 metric tons of silver in just the first quarter of 2026, treating it alongside rare earth materials as a strategic asset. On the gold side, the buying trend has continued with intensity. The motivation is not mysterious. Central banks, particularly in emerging markets and countries wary of dollar-denominated reserves, are looking for alternatives that cannot be frozen, sanctioned, or inflated away. Gold cannot be printed. It does not have a counterparty. When a country holds gold reserves, those reserves do not disappear if the United States imposes financial sanctions, which has become a genuine risk calculation for a number of sovereign wealth managers. Central bank buying creates what analysts call structural demand that is relatively insensitive to price. A central bank buying gold for reserve diversification is not going to stop because gold moved from 4,500 to 4,800. They are making a long-duration allocation decision, not a short-term trade. That creates persistent upward pressure on gold that exists independently of whatever the Iran headlines are doing on any given week. It is one of the reasons the gold price floor has risen so dramatically over the past few years. The buyers with the deepest pockets in the world are not sellers at these levels. They are buyers. Now let's bring all three of these stories together. The Iran situation is the most immediate variable. If Trump and Iran reach a final signed agreement that includes reopening the Strait of Hormuz and serious nuclear commitments, you would expect oil prices to fall meaningfully. Lower oil means lower inflation expectations, which gives the Federal Reserve more room to cut rates. A more dovish Fed tends to weaken the dollar, and a weaker dollar is generally a tailwind for both gold and silver. In that scenario, gold might pull back initially on reduced geopolitical fear, but would likely find support from structural central bank buying and potentially reapproach higher levels once the dollar softens. Silver, with its industrial component looking more attractive in a lower rate environment, could see a meaningful move upward. On the other hand, if the deal falls apart, if Trump's demand for tougher nuclear concessions proves to be a deal breaker, if the ceasefire breaks down, then oil stays elevated, inflation stays high, the Fed stays hawkish, the dollar stays firm, and gold remains in that tug-of-war between safe haven demand and rate pressure. In that environment, gold likely stays range-bound, while silver faces continued macro headwinds, partially offset by the physical delivery dynamics we discussed. The most important thing to understand here is that neither outcome is clean. Gold is responding to geopolitics, to the dollar, to real interest rates, and to central bank demand all at once. Silver is responding to those same factors plus industrial demand, plus the physical squeeze dynamics at COMEX. When you watch a headline that says gold drops 2% on Iran deal optimism, you are only seeing one piece of a much larger puzzle. Let me give you a mental framework for thinking about this going forward. Think of gold as having two separate engines. The first engine is the fear engine, geopolitical risk, financial instability, currency debasement fears. That engine is running hot right now because of Iran, global debt levels, and dollar credibility questions. The second engine is the rate engine. Gold tends to rise when real interest rates are low or falling, and tends to struggle when real rates are rising. Right now, the rate engine is working somewhat against gold because oil-driven inflation is keeping the Fed cautious. When you understand that gold has two engines currently pulling in different directions, the price volatility makes a lot more sense. It is a tug-of-war between fear support and rate pressure. Silver has those same two engines, but also a third that gold does not: industrial demand and physical scarcity. That third engine is running at full power right now, regardless of what Iran does or what the Fed says. The COMEX delivery data does not lie. Companies need the physical metal. The vaults are draining. The paper-to-physical ratio is at levels that historically have preceded significant repricing events. That does not mean silver is going straight up from here, but it does mean that the floor under silver has structural support that is not entirely dependent on geopolitical outcomes. One thing worth acknowledging honestly is the risk side of this picture. Silver hit a high of over $120 in January 2026 before dropping approximately 35% from that peak. That kind of volatility is real and significant. Precious metals, particularly silver, can move sharply in short time frames, even when the long-term thesis is intact. A rapid resolution of the Iran situation could take meaningful geopolitical risk premium out of gold relatively quickly. Analysts see around $4,400 as strong support even in a deal scenario, but getting from $4,500 to $4,400 is still a real move that hurts if you entered at the wrong moment. Risk management, position sizing, and a long-term perspective are genuinely important principles for navigating a market this complex. There is also the Federal Reserve dimension. The Fed right now is essentially trapped. If they cut rates to support the economy, they risk reigniting inflation at a time when oil prices are already elevated due to the Hormuz situation. If they hold rates too high for too long, they risk tipping the economy into a slowdown. Neither path is clean. That uncertainty is one of the primary reasons we are seeing such choppy price action in gold and silver rather than a clean, sustained trend in either direction. What does all of this actually mean for everyday investors? Gold and silver are doing what they have historically done in complex, uncertain macro environments, reflecting the tension between stability and instability. When the world feels more orderly, they pull back. When things feel more chaotic, they move higher. The difference in this particular cycle is that the structural underpinnings, central bank buying, physical silver scarcity, COMEX delivery stress, consecutive years of silver supply deficits are adding a layer of demand that does not simply disappear when geopolitical tensions ease. That structural layer is arguably more important for the long-term investor than whatever happens with the Iran deal in the next 2 weeks. For someone trying to think about what to watch in the coming days, the most important variables are 3 things. First, the Iran deal progress. Specifically, whether Trump signs off on a final agreement or continues pushing for tougher nuclear terms. Any credible sign that the Strait of Hormuz is genuinely reopening will be a significant market event. Second, Federal Reserve communication, particularly the personal income spending and inflation data due this week, which will give the market a read on whether oil-driven inflation is feeding into broader prices. And third, continued monitoring of COMEX silver inventory and delivery data, because that structural story is unfolding in real time and is the variable most casual observers are not tracking closely enough. The Iran situation is dramatic. It makes headlines. It moves prices on a daily basis. But underneath that noise, the physical silver market and central bank gold accumulation are the longer duration forces quietly reshaping the precious metals landscape. The geopolitical drama is the weather. The structural demand is the climate. Any investor who wants to understand gold and silver in 2026 needs to be watching both. That is going to do it for today's breakdown. The Iran negotiations are genuinely fluid. By the time you are watching this, there may have been new developments, so keep an eye on the news. Think through how any update maps to the framework we discussed. And remember that markets this complex rarely move in a straight line. The volatility is real, but so is the structural story underneath it. As always, nothing in this video is financial advice. I am not a financial advisor, and everything here is purely for educational and informational purposes. Do your own research, speak to a qualified professional before making any decisions with your money, and think carefully about your own situation and risk tolerance. Thanks for watching John Smith 02. Stay sharp out there, and we will see you in the next one.